Let me start by telling you the most important thing you need to know about inflation. Forget about the CPI, the PPI, the PCE, and all the other alphabet measures of inflation you read about. The only inflation rate that matters for investors is real asset inflation. Here's why. Both real and financial assets have total returns, just like in the finance books. Both returns have a current income component and a capital gains component. Both are affected by inflation. The current income component of real asset returns is the rent you collect as a landlord or the value of living in your house as an owner. For financial assets, it's the interest you collect on a bond or the dividends you collect on a stock. The capital gains component is simple. It's just the annual percent increase in price for each asset. Real asset inflation matters because it measures the capital gains component of the total return on real assets. That's what investors compare with the total return on financial assets when they decide what fraction of their net worth to keep in each bucket. When real asset inflation goes up, the total return on real assets goes up too, both as an absolute number and relative to the total return on financial assets. The change in relative returns when inflation rises makes people sell a portion of their stocks and bonds and invest the proceeds in real assets. That drives real asset prices up and stock and bond prices down. That's why people buy real estate, commodities, artwork, gold coins, classic cars, and baseball cards as inflation hedges. And that's why inflation and interest rates move together over long periods of time. You don't have to be Warren Buffett to figure out what to do in this situation. Re-slice your asset pie by moving some of your money towards real assets before all the other investors get the memo. Then let the tidal wave of repricing caused by other investors' actions increase your net worth. There are finer points to consider too. Regarding bond duration, shorter is better than longer. Regarding leverage, less is better than more. Regarding financing, fixed rate is better than variable rate debt. Regarding sector mix, more cash flow, more dividends, and more stock buybacks, fewer unprofitable companies with big growth stories. As always, I welcome your comments and invite you to join the discussion with me and my extraordinary group of subscribers. I'm John Rutledge.